Everyone, welcome back to another episode of QSBS Solved. This is part 3 of our QSBS Masterclass with Scott Dolson. This section based on an article of Scott's titled Substantiating the Right to Claim the QSBS Tax Benefit. And the articles that Scott has put out on this is actually a fairly extensive two-part series on substantiating QSBS. But what we want to do today is talk about what does it really take to demonstrate that you do own QSBS, qualified small business stock? And so, Scott, glad to have you on for another episode here, and excited to jump in.
Yeah, I mean, this is about as important a topic as you can get. I'll just tell you a little bit of the backstory. So, I've been working on this 1202 area for 7 or 8 years. And, maybe it was a year ago. I don't know if it was that long ago, but maybe it was. I was having lunch with Bob Webb, another lawyer in our office, and he does tax litigation. And I mean, he does white collar crime and, criminal tax stuff also. But we were just talking about 1202, and I was talking through with him. It was actually one of these 1045 issues. I was kind of explaining, for someone who doesn't really know about it, what it means to reinvest under 1045 and how, some of the clients, things don't work out and you end up liquidating. And his reaction to all of that was, well, that would be a really hard thing to substantiate in tax court, and so I was like, well, I mean, so what it really did is it just kind of triggered, me really digging in and having, I think, a more fulsome understanding of, the whole tax administrative process, tax penalties, what it means to provide to be able to substantiate something in tax court. In other words, provide the background factual information, documents, to prove your case so that if you claim, I mean, it's one of two things. You're either taking a return position, claiming a 1202 gain exclusion, or you're making a 1045 election to reinvest proceeds. So if you do that, and the IRS audits you, number one, what is it going to take to convince that auditor that you're not low-hanging fruit for them to come after? And number two, if you actually end up in tax court, what is it going to take? And so what do you need to do? And
Yeah.
the other leg on this thing is, I have a lot of conversations with people, and this is kind of within your ballpark too, with people who are thinking about going into a 1045 reinvestment. And, they're not used to it. They don't know anything about it other than maybe they've seen one of my articles or something. I really feel like it's my job, and these articles are basically sort of telling them, here's what you need to do, because you don't want to be in that situation, which I've been in on my end, dealing with part of it is 18 months later, you get an email and they say, we need to have a meeting with our accountants. And you get the accountants on and you get the client on, and what you find out is they haven't done anything. And so the accountants are like, we can't sign a return taking the 1045, making the 1045 election. There's no evidence of active conduct that's required. Or it could be, taking the gain exclusion. But that's the other thing that I see. So when I told Bob all of this, Bob's like, that would be hard. It would be possible. And, Bob's the one saying, you end up having experts testifying for and against what was done and all of that. So that just triggered, I would say, a really, shined a bright light on the whole substantiation issue. I'll have to be honest, I don't think I even ever used the word substantiation. I mean, I kind of conceptually know what what the definition is, but how it's used in the tax litigation world, you need to substantiate your position. I wasn't really that familiar with it, but now I hope I'm very familiar with it. And to me, it's like of paramount importance in this whole area of dealing with Section 1202 and 1045.
And it's front of mind for us, because for you and I, because this is what we do and we deal in the weeds of it. But for your typical, say, startup founder, a lot of what we're talking about probably sounds like boogeyman, scary, like worst case scenario stuff, but that's what we deal in, right? Like that's what we deal in, helping to mitigate is worst case scenario stuff. Your typical founder isn't, sitting there day to day running their company thinking, do I have all my ducks in a row? What kind of documentation do I have? Can I substantiate this or that? They're just running their business, right?
Right.
And so it's important to have folks who do care about the the worst case scenario. I'll tell you what this is what I tell folks who ask about substantiation and IRS risk and these kinds of things when they come to us about a rollover. And first thing I say is, I mean, with the amount of money that most of our prospects and clients are making, just call it, I don't know, $5 to $25 million. The reason why they might be audited in the first place is largely due to the fact that they're about to make a large amount of money. I mean, if you look at the statistics on audit rates, I think you have a 4 to 6 times higher likelihood of being audited if you're, have a gross income above with something like $2 million. And so at baseline, just statistically, these folks have a higher than average chance of being under inspection from audit. And so I frame what we do in terms of helping folks do QSBS rollovers in an eligible way and do substantiation the correct way is, okay, you might get audited. That's fine. But let's make sure that the reason you're not successfully audited isn't because of QSBS in one way or another. You might have done something else wrong on
Right.
your taxes, but the reason we exist and Scott exists is to make sure that we cross T's, dot I's, and substantiate. To use the word, where necessary. So that's why I say, QSBS, claiming QSBS doesn't automatically. We have no reason to believe that it automatically makes you more prone to an audit one way or another. We actually don't see a ton of sort of public information on any of that. And Scott, anecdotally, I'm sure you can share, but we don't see a lot of activity in that space. It doesn't mean you shouldn't be careful.
Yeah, I mean, I don't believe that there at this point in time there's a lot of audit activity going on. But the problem with 1202 and 1045 is it's it's down the road. I mean, we're planning today for things that you might end up being audited, anywhere from, a year or two from now to 7 or 8 years from now. So we don't know what the world's going to be like at that point in terms of IRS audits. So I just have to, I feel like my mission is to assume that we're going to be audited and assume that we need to position ourselves to win that audit or win in tax court. That's my job. I my role in this is to, I'm kind of a tax advisor because, it's basically you're consulting. I'm not implementing. I mean, I'm telling people, here's the problem, setting the table of, what you need to worry about, why you need to worry about it, what you need to do. And then, I'll look at budgets and business plans. I'll provide people tax advice about, they're going into an M&A process, they're doing X, they're doing Y, but either they or Brady Weller or employees of the company, they need to be doing it. So, my job is to kind of tell people what they need to be doing. Then they need to actually do it, sometimes with your help, whatever it is, but I can't do it for them. At least I can't do it for them.
Well, let's speak to, if you can, speak to the CEO who hired a CFO a year ago because they're planning, hopefully, for a liquidity event. And the CEO hired the CFO because he doesn't want to deal with it, but he needs to understand. So speak to both of those folks, speak to the CEO and the CFO, and let's talk about documentation of financials. And what would be the best case scenario for a founding team coming to you or a CFO coming to you and saying, here's what we have. How does this help us or hinder us in substantiating our positions?
Well, I think for the basic 1202 company, I would say what you need to, number one, you certainly need to have just a very healthy understanding of, what the requirements are to be eligible to claim the gain exclusion. And I realize, the attention span on that when you're trying to run a business and all of that, you know, we deal with. But you need to at least know when to come and, call and say, what do you think about this in terms of 1202 and what we're doing? I mean, ideally, so you would need to have be somewhat of a student of it, because if you're not a student of it, you might have a foot fault that, ruins your ability to claim the gain exclusion. What I talk about in the article is the concept of a QSBS file. And the QSBS file conceptually means that you're pulling together the information and documentation from day one of the issuance of the stock all the way to the time the stock sold, that will help substantiate that you've met each of the eligibility requirements. And part one of the article kind of grinds through each eligibility requirement. I mean, some of them are hard to conceptualize how they would actually be proved in tax court, and they've never actually been aired out in tax court. I mean, the one, I used 80% of my assets by value during the entire holding period of somebody's QSBS stock. 80% by value of the assets were used in qualified activities. Now, how do you prove that? You probably have the CFO or other management people testifying that we used, typically you would hope they testify we used all of our assets in connection with the business. And so then you say, well, did you have cash around you didn't need? And then you look at that issue. Did they have cash and investment assets? Did they buy rental real estate? Did they do things which evidences that they weren't using 100% of their assets? And do you have that information, and have you dealt with that so that you can be able to substantiate this, that in fact, and I would hope it would be through testimony of that CFO showing financial statements, but we don't know for sure. We do know things like, for instance, there's the JU case. I guess I don't know if it was Jew or however you pronounce the name. That is a situation where, somebody had information about the years 2009 and 2010 about the aggregate gross assets of a company. And at that point, the aggregate, and so there's this $50 million test. So at that point, they were able to show, based on financials that I presume were submitted to the tax court as evidence, that they only had $2 or $3 million, let's say, of aggregate gross assets. The problem was the year in issue was 2003. And they sort of thought, well, it's reasonable to say if it's only 2 or 3 million in 2010, I mean, do we have to worry about whether it was over 50 million in 2003? And, the IRS was smart enough to latch onto this. They said, how do we know that it wasn't 100 million in 2003? You didn't provide any evidence. You cannot substantiate this issue. This is one of the issues you have to be able to prove eligibility. The taxpayer has the burden of proof. The job of the government is to try to interpret as narrowly as possible gain exclusions. So within that nasty framework, you better be able to present financial information about 2003, or you'll end up in the place of that taxpayer who lost because he couldn't provide, apparently, or his advisors either weren't smart enough or capable enough or didn't have the information on 2003. So you lost. So that just shows, if you do end up in tax court, or you end up with an auditor who just wants to nitpick, which they may well want to, over millions of dollars of gain exclusion, you better be able to step up and grind through each one of these eligibility requirements because I'll tell you what the IRS is probably going to have. They're going to have the nutshell kind of 1202, like a paper that says, kind of the ABCs of 1202. And then they're going to have a checklist, and it's going to have all the eligibility requirements, and they're going to sit down in front of their, the person on their side is going to be the accountant or somebody for the taxpayer, and they're going to go through each one of these things, and if you can't prove it, if they want to, they can just send you on up into the appeals process and into tax court. So you have to be prepared. You have to think through, here's each of the eligibility requirements. What paperwork, documents, or testimony do I need to be able to prove each one of these? Some are easy and some are a little bit like, how in the world can you exactly do that? But you have to be able to do each one.
Well, so you and I are, for our clients, sometimes trying to be problem solvers because not everything's always perfect, right?
Right.
So say you have a CEO who's 3 years into their business, and they were kind of fumbling around for the first 3 years, and they finally hit on their concept, and they didn't have the right accounting in place. They didn't have a outside consultant that was helping them with their P&L. So they're trying to pull things together and paper over years that they didn't have a lot of formal documentation week to week or month to month, quarter to quarter. Where do you start where there's a gap, say in
Well,
2000?
I mean, I'd find out who has if anybody has actual knowledge about that period of time. I mean, if there, somebody does, I have to identify who that person is. And probably, I mean, ideally, I guess if it's like the fired CFO, you get some kind of affidavit certificate from them. You find out, you backfill the paperwork to the
And you
extent
could just be
possible.
looking through like bank statements at that point, right? Like,
You might, whatever it is. I mean, you have to. So this is what this is what I do as a tax planner, but I understand the problem. This is what tax litigators do. They have to go in there and they have to prove their case, and they have to figure out how to find the evidence to prove the point. And sometimes I think it'd be really difficult if you don't know up front what you need to do. I mean, if you didn't keep any paperwork, for the first 5 years and you sold after 10 years, it's not going to be easy, but I mean, we will help as much as possible to try to backfill what these articles are intended to do, I hope, is to get people kind of upfront to understand what the challenge is
yeah,
and what they need to do, and so we're kind of working both ends of it, new people who need to do all this right on the 1045 or the 1202, and then kind of on the back end, particularly when we're working on opinion letters, we're sort of working backwards of how do we, we know what all the requirements are. How do we substantiate each one of those, And I mean, some of them we realize that it's just testimony of the founder, and I mean, look, there's no way to know if that's going to be acceptable to the tax court. It may be the only thing that's available, but they could say, well, you don't have anything to corroborate
Mhm.
your testimony. But I mean, I mean, you have to do the best you
Yeah. I
can.
mean, obviously, I'm asking this because the infrastructure around documentation and accounting and your general ledger isn't always perfect in the early
Right.
stages of a business, and so it's certainly something that we run into. Another thing that we run into is sort of there's just weird foot faults that happen along the way, like a co-founder falls out with the others in the team, and maybe some redemptions happen. Then they go on a hiring spree, and there are some questions about whether or not each cohort of new hires had or didn't have QSBS because of some of the restrictions.
Well,
Uh,
we hope that founder. We argue that the founder stock was for services, and that the redemption is within an exception under
mhm.
1202. But I mean, we do run into irreconcilable foot faults on the anti-churning test. That's the kind of thing you would hope to educate people up front about. But I mean, sometimes there are things that have been done that, you can't put the genie back in the bottle. And we're like you. I mean, sometimes we see, a lack of organizational documents for the company and you name it. So, I mean, I guess the message is I've done everything possible with part one of this article to go through each of the eligibility requirements and try to think, actually think, what would it take to prove that? And if someone read that, maybe they've got some additional ideas, but the concept is, well, that's what you need to be doing and you need to have. And, if people come to us after the fact and, when it's time to get an opinion letter, kind of we're in the business of seeing, well, okay, what information do you have? Who knows about stuff? And, how do we put it together? I mean, you could have a situation where you have a founder that was in there the whole time. Maybe they're still CEO and they can get the CFO to focus a lot of attention, all the way to the situation where you have an early stage investor or employee who got fired and nobody will talk to them anymore and they don't have anything, so, and everything in between.
Yeah, there are two types of outside, call it like formal and semi-formal documentation that you can also get to help you navigate some of the substantiation work. One of them that listeners may have heard thrown around is this idea of an attestation letter. And I know that Carta and some other cap table management platforms will issue these little certificates or basically notices in your equity management portal to basically say, hey, based on holding period and what we know about the assets of the business and this type of thing, it seems like you may have QSBS. And then on the other end of that, there are tax opinion letters, which could be written by someone like you, Scott, which can provide in-depth analysis of a particular claim that's being made on someone's tax return,
Right.
like QSBS. And let's talk about those two separate pieces
Well,
of.
so an attestation, let's just think about what we're getting there. So we're getting a couple page thing that kind of checks off that says, I looked at stuff and based on my looking at it, I think as of a moment in time, you have QSBS. Let's say that's what you get. Now, you know, that could be perfectly useful. Like, if you thought the person knew what they were doing and you wanted to know whether you had QSBS, that paying for that might make sense. I mean, the two things you really ought to want to know about is who did this and what's their experience and expertise and what's the process they followed. And, I've seen a lot of different attestations and some of them just don't tell you. And so if you're paying for that, how do you know what you really got if you don't know, who did it? You can make jokes. They pulled someone off the street with a shopping cart to do it or something. I mean, you don't know because it doesn't say. But you can ask the questions, right? I'm not going to pay you to issue an attestation unless you tell me who does this, what's their experience. I mean, that's what you want to know about a doctor, right? What have you done? You're going to, have a heart transplant. Tell me what your background is. How many heart transplants have you done? All this stuff like that. So think of that's what an attestation gives you. If you trust the judgment of that person and you're doing something where you want to know if you got it, 1202 stock, it's very useful. Now, in most cases, it's entirely useless for substantiation purposes. Number one, because they'll say right on them, they're not tax advice. They can't really be relied on. And they don't give you the background. I mean, if I'm an IRS agent and you stick an attestation in front of me, I'm going to say, well, that's fine. That person thought that, but I don't know what they did. There's no analysis in here, So, and there's no documentation. They didn't provide me with the backup. Yeah, we've got some guy out there that I don't know 1,000 miles away who said, 2 years ago, they looked and that they thought the stock was 1202 stock. I mean, that's great, but it doesn't prove anything to me. So I don't think as from a substantiation standpoint, they're very useful. Now, on the other hand, if they tell you you're screwing something up and you fix it or whatever, that's great, but you see what I'm saying in terms
It's
of
good as a
actual
road sign.
substantiation.
I think
Yeah.
it's good as like, hey, if I log into my just say Carta portal and I see I
Uh-huh.
don't know what it is, like a little exclamation mark that says this
Yeah.
must be QSBS. That's great. Now I know that I need to go and find Scott or find Brady or find someone.
Yeah. You need you, nothing wrong with that. It's useful for its own purposes, but it's not substantiation.
Correct.
And so that's what I think about attestations. It's like, would I get one under some circumstances? I'm doing something like I'm thinking about going into an M&A process. I'm going to issue incentive equity. I just need to know. Then I think, if I thought someone at Carta really knew what they were doing, I understood what they did, I might pay whatever it is they want to charge. Now that's an attestation. And, there are more fleshed out ones, like some accounting firms do more fleshed out ones, but they're not, they're not typically providing you with two things. One, they're kind of conclusory, so that they're not doing two things. One, they're not giving you the background information about how they reached that conclusion. Okay. Which you need to know later on for substantiation. It's like they reached that conclusion. What do I need now to do to prove it? Because I probably hired some lawyer or accountant to fight with the IRS. So that's one aspect. The other one is, let's say there's a really problematic thing. You know, I want the, I personally want the analysis of why is it problematic? What arguments does the IRS have? What arguments do I have? I need the full picture because I'm going to have to deal with this. I'm going to hand this to my tax lawyer or accountant in an audit, and I'm going to say, here's your white paper to be able to address this issue. So that's useful. So they're really different things. There's the attestation world, there's tax opinions, and an opinion could be conclusory too, but it could also be what I call a reasoned opinion, which really sort of provides all the fleshed out information. And then there's other things that are important too that we ought to just mention, that are mentioned in the articles. Getting certificates at the right time from people on factual issues. You were talking about the CFO guy. Well, if I'm an investor and I'm coming in, I want to ask, I probably want a certificate. I want representations, at that point, if I could get them. If I'm in a fund investing and the fund is a QSBS fund, they should be asking for that kind of thing. So certificates of fact, what that translates into in litigation is those people are going to have to get subpoenaed and testify, So there's that piece of it. And then the new kid on the block, sort of, to me at least, this whole world, the world of tax insurance is moving into 1202, And so you're going to see that on the 1045 stuff. And
We've
I'm
dealt
seeing
pretty
1202.
extensively. We've dealt pretty extensively with insurance around QSBS and 1045. And it's you know, a good tool in the right situation, but in terms of substantiation requires significant amount of substantiation and a significant amount of upfront investment in terms of the premium of those policies. And so
Yeah.
we see
Yeah.
it, we see it only really making sense in extremely high tax QSBS eligible states like New York for exits above $8 or $10 million or gains above $8 or $10 million. And especially in cases where, a founder may have gains of, 8 figures or more, and maybe is looking at moving money to several trusts before an exit or doing multiple QSBS rollovers, more complex strategic situations. And insurance can be really great in those circumstances, but it's also could cost you several $100,000.
All right. Like, what is it, like 3 to 5% of the,
Yeah, typically
of the
minimum premiums are around $350,000, and so
yeah.
it only starts to make economic sense when you get, pretty large exits. So
Right. Right.
yeah, but that's
So,
definitely possible.
well, so I've kind of gone around in circles on, I mean, I hope I've laid out, what you want on attestations. And I mean, tax opinions, there's the issue of tax advice. So a tax opinion has several functions. I mean, one function is, you get a written work product and you read the work product, and you're a consumer of that work product. You can read it and say, this guy makes sense or he doesn't make sense. I mean, that's one use for it, right? You can decide yourself then. And the second possible use of it is, unfortunately, you get audited. And, you're 5 years later, you get audited, or 2 years later or something. And, it's your battle plan. I mean, it's your kind of white paper of why you think you should win your position and the arguments you should be making, and understanding what the IRS's arguments will likely be. So that puts you a little more in the driver's seat, certainly, than the average taxpayer, and maybe a little more in the driver's seat than the IRS on it, because it's written by someone that deals with it every day, and IRS people have to deal with a lot of different things. So that's the second function. And the third function is, it can be tax advice that a taxpayer can say that they received this advice and they had reasonable cause for taking their return position, and therefore, if you lose, the penalty shouldn't be imposed, 20% substantial understatement penalty. So that it really serves different functions,
which can be significant, right? To not receive penalties as part of a successful audit, if that were to happen. I know that there are other costs associated with maybe defending your audit and other things, but functionally, it puts you in a position where you're kind of back to square one of, hey, they're going to ask you for back taxes and a little bit of interest, but without having to pay those penalties, you're not so much more behind the eight ball than you were if you had just paid taxes originally.
Yeah, you had to have had a pretty good argument. I mean, the baseline is you had to actually have had substantial authority for your position. So you have to have some pretty good arguments, but that doesn't mean you have to win. Substantial authority, which is the base return position for anything you do on a return, probably is like 35 to 40% chance of winning. And that's less than 50%. So, you could certainly, it's not unreasonable to think you might lose and still have sufficient authority to avoid being hit with the penalty. I mean, but it's way above, a frivolous or sham position. And you can also, if you want to, and you need to, if you don't have substantial authority, file a form 8275 with the return, which basically discloses to the IRS the return position you're taking, for which you're saying, I don't have that level of substantial authority. So, you would think that people wouldn't be filing those if they didn't have to, because they were, I think they raised a red flag. But, I think there are a lot of those that get filed in the total country. And so, it's certainly an option. And it's something that any tax advisor needs to tell clients about, the ability to potentially support mitigating penalties through, that disclosure. So, yeah.
Yeah, and I guess the last thing I'll say before we wrap up here is I think that obviously, like we said in the beginning, Scott and I deal with worst case scenarios, or at least deal in trying to mitigate against worst case scenarios. But this conversation shouldn't be taken as QSBS being inherently risky to claim, however you want to define risk. But the reason we talk about it this way is because there's simply not a ton of information with regard to the IRS openly interpreting some of the rules here. And so there is some gray area. You do need someone like Scott to step in and make interpretations, sometimes legal interpretations on your behalf based on your situation, to help substantiate a position, because, it's not as cut and dry as, hey, what's my W-2 income tax stat for this given year?
Yeah.
Just have a little bit less information on QSBS than some other areas of the tax code. And so that's why we speak about it in maybe like high up here terms, up in the air terms, versus a lot of concrete language.
Yeah, I mean, the crazy thing about all this is it's not some tax shelter product some crazy people created somewhere. It's a statute that very clearly allows you what, some people think is an excessive gain exclusion, but it's the law.
Yeah.
And, our job is to help make sure people can prove they're entitled to claiming it. And there's certainly no reason to think that people aren't entitled to claim it.
Yeah, I mean, maybe it's an excessive exemption, but what's also excessive is the amount of value, jobs, and GDP generated from the types of businesses that we work with. So, this is where,
Exactly right. That's
to me,
exactly
this is where we want to see. This is where we want to see our money
yeah,
go. We want our hands, or we want our money in the hands of founders, entrepreneurs, investors of capital, folks that move the ball forward. So,
yeah.
yeah, Scott and I are here to help you substantiate those things. And Scott, thanks for your input. These are great articles. Use them as a checklist if you're working with your CFO towards an exit to make sure you have documentation in line. All right.